Hello, everyone. Welcome to our market review, first quarter of 2023. Get my slides going there. There's my smiling face. Most of you are familiar with me, so I am your Chief Investment Officer, and I'm excited and privileged today to walk you through some of our thoughts and review the quarter with you. So you've seen this slide before. We're talking about two sets of investors. On one side of the coin, you have the investors that are worried about the macro geopolitical risks. And so that should say tails, by the way. That shouldn't say heads, that should be tails. But on the tail side of the coin, we have investors that are worried about the geopolitical risk. And so they're hunkering down by maintaining diversification, looking at bonds, looking at lower risk off assets and strategies. And of course, the problem there is with high inflation, you have a negative real return. But on the other side of the coin, you have the people that want to fight inflation. So you're in equities and growth and value and energy. And last year that didn't pan out so well, right? And so we still see people conflicted. So really what we want to do is talk to you about maintaining the right amount of exposure to risk on assets and the right amount of exposure to risk off assets. And so if you flip a coin, it's really hard for it to land on the side of the coin. So here we have plenty of strategies that can help with the risk off and with the risk on. The number one thing that we think you can do is to integrate that in the financial plan. There's still risk that remains, so maintaining a hedge position, which we'll talk about, we think is still prudent. However, the first quarter has been great. Equities are off to a good start in 2023. Risk on is back in favor, where risk off was definitely in favor last year. This year, even though there's a lot of risk that we'll talk about that remain, the market's starting off pretty well. On the other side of the coin, we still have bonds doing a lot better. And that's probably one of our favorite portfolios right now is the individual bond portfolio. So the landscape is shifting, but we always want to maintain the right amount of risk on and risk off exposures. Let's talk about cycles. So this chart shows the expansion, peak, trough, back to expansion, recovery and expansion cycle of the economy or business cycle. And the reason that we're a dynamic and adaptive manager is that things cycle, right? Investments go in and out of favor. And so we manage our portfolios and adjust our portfolios based on the cycle. So if you think that we're at the bottom of a cycle, you want to be in risk on assets, okay? If you think that we're at the top or the peak of a cycle, you want to be on risk off assets, okay? So again, if you knew for sure we were at the peak, you'd want to be all equity. Or all risk off, all risk managed. If we're at the bottom, you'd want to be in all risk on assets. If you're not sure, or you think maybe we're at this point in the cycle, you probably want to have a little bit of both, right? You might want to have 50% risk off and 50% risk on, or 60-40 or 70-30, but you're going to have some combinations of the two, okay? And so when you look at our portfolios, again, we have portfolios that are designed for risk off, and we have portfolios that are designed for risk on, and then we can combine those in any combination to satisfy the risk temperament and investing needs of each client, okay? So let's look at another cycle chart. This is going to look at the different sectors that might work at different parts of the cycle. So early expansion, mid-cycle, late cycle, you'd expect technology, industrials, and energy materials to do well. What's really interesting right now is that the defensive sectors are doing terrible. The healthcare, utilities, telecoms, discretion, banks, okay? So I think we are, we're in this early to mid recessionary period, but what should be working historically is not working. What has been working in the first quarter have been the FANG stocks, have been the technology stocks. In fact, the technology stocks, the NASDAQ is back into a bull market. Okay, it's up 20% from its lows. Now, that doesn't mean the S&P is in a bull market, and it doesn't mean that we might not have a recession, and it doesn't mean that there's risk remaining, but the data shows that the high tech and the NASDAQ have done very well, or technically in a bull market. So We'll talk more about that and on how it affects the portfolios. For those of you that want to see what's in each one of these sectors, you can look at this chart. This is just the chart of ETFs and the top 10 holdings of each of these sectors. Okay, I'm not going to spend much time on this now in the interest of time and getting you, not making you watch a video all day, but you can come back and look at this. And if you're interested to see what company makes up the top 10 in that sector, you can refer to this chart here. Okay, because of those cycles, right? Because things move and shift, our value proposition is to be actively managing these cycles. And the way that we do that is by building robust and prudent and purposeful portfolios by blending quantitative methods, fundamental analysis, dynamic modern portfolio theory. Okay, and so in essence, we can hedge to any degree that we need to. We can be long stocks, short stocks, and cash all at the same time. So again, the reason that we choose to be an active manager is because we know that these cycles and sectors and asset classes are always changing, and so we need to adjust the portfolios as appropriate. Okay, let's look at a quick review of returns for the first quarter. What we're looking at here are some of the major indexes and asset classes and sectors that we monitor. And you'll notice that 75% of this sector, this universe, was positive in the first quarter. Now, what's interesting that if you equally weighted, if you bought a little bit of everything, your return would have been 4.69%. But if you'd been in the semiconductor space and technology, you'd be up in the 24, almost 25% range. Again, there's that NASDAQ QQQ up at 20%. On the other end of the spectrum, no surprise, the regional banking sector is down 25%. Okay. Now, but what is a little surprising that we saw from that prior cycle chart is that we have things that should be doing better, like that financial sector, like the commodities, like energy. Okay, commodities. These things you would expect to be doing a little bit better in this cycle, but they're not. Okay, it doesn't mean that they won't. It just means that the markets come roaring back this first quarter into that large cap growth area. And so those tech companies that had difficulties last year, those FANG stocks and Amazon and Microsoft, et cetera, have had great years so far. I think Meta's up 100% since November. Tesla, even this year to date, these stocks are up big. So that they may not stay that way, but right now that's what we have. Okay, so we have a lot of returns coming from the technology sector. And again, that's interesting, and it's interesting that the traditional sectors that we would see late cycle are not performing as you would expect. Okay, let's look at our portfolios. So here we can see that our risk on portfolios have done quite well because that's where the returns are. So our ESG portfolio, the focus blend, those are 10, 12%. The faith-based, the value is doing well. It's not as good as growth, and we'll see that growth is in favor. Metals is down because it's a hedge, right? Focus growth is up considerably more than the S&P 500, and it's still holding 25% cash. Okay, dividends are slightly negative for the year. They were positive last year, so they ran up and had a great return last year. And so it's not surprising to see that value is starting to slow down a little bit as the market has rotated to growth. And then real estate, again, our real estate did very well against the index last year, and this year it's starting off a little bit slower than the index because we have some companies that are running out of value and they're at the end of their life cycle, and those will be rebalanced here shortly. Okay, so that's how the risk on portfolios, in general, they're working very well. Let's look at the Sailboats, which is one of our tactical or focused tactical allocation portfolios that's really a risk off strategy. Let's take a look at that. What we're going to see here is that the Sailboats are really flat for the year. Okay, slightly positive to negative, and that's making sense because in the Sailboats, we're still hedging. We came into the year with a little bit of short equity. We came in with some cash. We were shorting some bonds. So the sailboat is really meant to be defensive, right? but they're not going to perform well when the market goes into a risk-on mode, right? When the market goes into a risk-on mode, you're going to want to have equity exposure. We're also recommending people taking a look at moving from the sailboats into the individual bond portfolio, because now that the bonds interest rates have come up, they're offering a better risk-adjusted return than the asset allocation. So you'll see some of you'll see some people wanting to move from the sailboats to the individual bond portfolio. Now, our more traditional asset allocation portfolios, the tugboats and speedboats, those are more in line with the indexes because they don't hedge as severely as the sailboats. Again, when you're at the on the golf course and you're at the tee, you want to use your driver. When you're in the middle of the fairway, you want to use your 7-iron, and when you're on the green, you want to use your putter. So again, here, based on different points in the cycle, we want to use different portfolios. So we have, upwards of 25 portfolios, and they're all doing what they're supposed to be doing. It's just some are going to work better at different points in the cycle. Again, depending if we're at the bottom, the middle, or the trough, or the top, we need to look at rotating those portfolios. Okay. Let's talk about a recession really quick. We don't know when, we don't know if or how long or how deep. We don't know what the Fed will do, but we'll talk about what we're watching and what we do know, and how we make portfolio decisions from that data. So what we're looking at here is the change in unemployment over 1 year. And we know that there's not a level of unemployment that is predictive of a recession. For example, if unemployment gets to 8%, there's a recession, or if unemployment gets to 3%, there's a recession. But there is a strong correlation between the rate of change in the unemployment rate year over year. So how we read this chart are these red areas are recessions. The green line is the raw unemployment level, which is about 3.6 currently. And the blue line is the 1-year rate of change in the green line, the 1-year rate of change in unemployment. So what you'll notice is that when the 1-year rate of change goes from 0 to 1, a recession follows. 0 to 1, recession. 0 to 1, 0 to 1, 0 to 1. So every time that the rate of change goes from 0 to 1%, it's been a strong indication of a recession. So we're watching this come up, and we'll be watching to see if we get to 0 to 1, and that would be a strong indication that a recession is to follow. On this slide, what we're looking at is here's the S&P 500 on the top panel. The middle panel is the New York Fed's probability of a recession, and that's at 57%. The bottom panel is the Bloomberg index, and it's at 100% of a recession. So there's a lot of people that said we're in a recession now, that we were in a recession last year when we had 2 quarters of negative GDP growth, and some say that we're not. But according to this data, there's a 60+% chance that we're going to have a recession in the next 12 months. Now, what does the Fed base their numbers on? What they're predominantly looking at is the spread between the 3-month and 10-year Treasury. And so you can see that relationship is negative, which will also manifest itself in a negative yield curve. And both of those are stronger recession indications. When we look at the surveys, we see that the mean is a 63, almost 64% chance, and the median's a 65% chance of a recession. So this data is coming from Bloomberg, and Bloomberg goes out and they interview and survey contributors, right? Banks and brokerage firms and economists. And so this is the best guess of people that have been asked what the probability of a recession is. So again, 63, 64, 65%. We saw the Fed model at 57. So let's just call it 60, mid 60% probability of a recession over the next 12 months. Now, there's still a 40% probability that there's not a recession, and we'll talk more about that. So to continue the conversation on the recession, we have to look at the ISM indexes. We have to look at the manufacturing and the services index. And what the ISM manufacturing and services index do is they go out and survey companies and decision makers to see where they think productivity is going to be in the future. So what are inventories going to be? How many people are they hiring? What's their capital expenditures going to be? So this is a forward-looking number. And anytime that the number is below 50, it's contractionary, okay? And anytime it's above 50, it's expansionary. Now, the other measure of GDP or economic output that people like to look at is the gross domestic product. The gross domestic product is a backward-looking number, okay? So we know what activity was. This survey from the ISM is looking forward, so we can get information looking forward and backward. On the bottom panel, we have the Fed funds rate in the orange line. And what you'll notice is that the Fed raises rates when the economy's been doing well, okay? And the reason they do that is to slow the economy off. And so here we can see that the economy was doing well. The Fed raised rates to slow it down. They paused. The economic activity dipped shortly, but there wasn't a recession, okay? And so because there wasn't a recession, they kept rates flat for a long period of time. During 2000, 2001, right, see, the ISM indexes were strongly and consistently above 50, strong economic activity. Fed raised rates to slow the activity down, which they did. The ISM indexes came and broke 50. They paused, okay? And then, of course, they stayed below and a recession followed. Here again, strong economic growth, sustained economic growth. Fed raised rates to slow it down. They paused as these lines got to 50, but they couldn't stop the train. The economic activity contracted, and that caused the recession. And so we see this pattern again here. Great economic activity, raise rates to cool it down, pause, recession. And so this is a natural cycle, right? If we think of this, this kind of looks like that cycle that we saw earlier. So, I think the Fed, I don't know if their mandate is to prevent another recession, but they've kind of been acting like that over the last couple decades, right? Or last 15 years or so, last decade at least. And so what's going to happen now? Well, you can see here we had strong economic activity. The Fed's is raising rates at a historical level or a historical rate, and we'll have to see. Okay, so let's go to the next slide to see if and when the Fed might pause. So here is we're trying to answer the question, when may the Fed pause? On the white line, we see the Fed's favorite level or measurement of inflation, which is the PCE. It's the personal consumption expenditures, year-over-year change. And that's currently about 5.6. You'll see that the orange line is the Fed funds rate. So, simple math says if the Fed funds rate is higher than the inflation rate, that's good. That should start to look like the Fed could pause because inflation is coming down. Additionally, we've seen the banking crisis recently, and that's probably given them a reason to pause. Okay, so we're getting to a point that we could see a pause. I think a lot of people think we have already paused, and based on the inflation data that came out today, yeah, maybe we still get another 25 basis point. Maybe they're not quite done, but the data says they're probably getting pretty close to being done. Now, the next question we want to ask is, well, what should rates be, right? And so here we can look to the Taylor rule, which is just a fancy algorithm that says that the economy could be about 9% rate. The rates could be at 9%, and the economy would not be contracting or expanding. Okay. Now there's an error in that, so maybe let's call it 7% or 6.5%. Well, again, we're at 5, so we're closing the gap between where rates probably need to be to cool the economy off and where we currently are. So this is the data that we're looking at. Okay, pause, rally, and a sell-off. Historically, the pattern has been that when the Fed pauses, the market gets excited because it thinks that the Fed's going to have to start lowering rates, right? Because a recession occurs. So again, economic activity, rates come up, we have a pause, economic index data ends up into a recessionary period, and the market drops, and so forth. Okay, so now the question mark is, we can see that the Fed hasn't paused yet. We think they're about ready to. And so can we have a soft landing? Well, if the economic activity doesn't dip very far for very long, then we could have a soft landing, or we could have a shallow recession if this doesn't dip very far. Like, here's a longer recession, there's a quick recession, another quick recession. So, there's still a 40% probability that we could have a soft landing. Again, is it likely? Well, 60% probability of a recession, 40% there's not, right, on average. So again, it's looking like we should be getting to a pause. Now, whether there'll be a recession and a drop in the market, we still have to wait and see. Okay, so now we can turn our attention to what drives the stock market. What's the market going to look like, look at, and pay attention to? So you've seen this before, because we talk about it every quarter. And the reason that we talk about it every quarter is because these are the things that the market pays attention to on a continuous basis: inflation, interest rates, corporate earnings, the Fed, and then, of course, geopolitical events. We still have elections to come. We still have debt battle to worry about. We have a banking crisis fallout that we're still watching. So there's still plenty of geopolitical horizons. We got the central bank's current digital currency. We've got the BRIC companies wanting to start their own currency to fight the dollar. You've got a strong dollar, which is making other countries want to look at replacing us. So there's plenty of geopolitical concerns and events out there that we're paying attention to. But let's walk through some of the primary things that we're looking at, that we can be a little more, we're not really in control of any of this, but we can understand and pay attention to and adjust portfolios on, and that's inflation, interest rates, and corporate earnings. Okay, on this graph, we're looking at inflation. This top panel shows the red line is where is the target level for inflation set by the Fed. The white line is the University of Michigan's 5 to 10-year inflation outlook, which is currently at 2.9. And the orange line, again, is the PCE annual inflation rate, which is about 5%. Okay, so inflation is coming down. It's not quite to where the Fed wants it, but the survey shows that it's going to be a lot lower than it is now. The University of Michigan's change in prices during the next year, so in this purple line, the median is 3.6. So again, that's improving. And then, of course, the headline news usually talks about the CPI, okay, and that's at 6%. And again, this was updated, as you can see, back earlier on in the month, or in April here. So these don't reflect today's announcements, where inflation was a little bit lower than expected. Okay. When we talk about interest rates, we can see here that the S&P 500 in this bright blue line, okay, is affected by the white line, which is the 10-year Treasury yield. So you can see as this 10-year Treasury yield has increased, equities have been falling, right, and so forth. They're almost a mirrored image of one another in the opposite direction. So here, it's no wonder that the stock market has been going down as rates have been going up. Again, what we see here is we see that the market this year, this first quarter, has really run, okay? Even though rates are still going up, the market's always forward-looking. It's always looking forward 12 to 24 months, and so it's anticipating where rates are going to be, and that's what it trades on. Same with earnings that we'll see, okay? So that's what's caused the markets to have that volatility. On the yield curve, it's inverted. So normally we'd like to see a positively sloping yield curve, which means you get a higher return for the longer you hold the bond. So it would look like this. It'd be a concave line. And instead we have an inverted line, which means that the short-term rates are higher than the long-term rates. A 4-month Treasury bill, okay, is at 4.94, where the 10-year Treasury bond is at 3.74. And so that's a concern for the economy. That's an indication of a recession. The next thing that we'll look at is the relationship between the 2-year Treasury yield and the Fed funds rate. And so right now you can see this orange line, the 2-year, is lower than the Fed funds rate. Now, why does that matter? Well, if I was selling hot dogs. If we had a hot dog stand, we would want to buy hot dogs for $2 and sell them for $5, right? It wouldn't be profitable to sell hot dogs for $2 and buy them for $5. That'd be unprofitable. Well, in the economy, when it comes to the banks work off a spread. So the Fed funds rate is the rate that the bank can go to and borrow from another bank overnight or a short-term basis when they need liquidity. If they don't borrow at the Fed rate, they borrow at the discount rate, which is directly from the Fed. But either way, if you're borrowing at 4.8% and you're only earning 3.8%, you're upside down. Those are negative margins. So again, that's not going to be profitable for the banks when typically in a raising rate environment, the banks would be doing very well. So I'm not going to get into a lot of the banking issues right now because that would take us a whole nother hour to discuss all the issues with banks. But we're watching it, we're aware of it, and this is the data that we're using to adjust the portfolio. So again, we would like to see the rate that you earn higher than the rate that you have to pay. So when it comes to where should rates be, we look at the dot plots. And so this is a chart that shows each yellow dot is where the Fed governor has voted. There's 18 voting governors, and they vote for where they're going to place rates. And so they're telling you where they're going to vote. And so here you can see that the median here is just a little bit over 5. Okay, we do have an outlier up here and an outlier down here, but you can start to see that they're starting to project that rates will start coming down here. Okay, sometime this year is what we would expect. They still may have a rate hike, but according to the dot plot, by 2024, these rates are going to be coming back down. Okay, the futures markets, which are live markets and a great price discovery mechanism, they're having them come down a little faster, but the slope is the same. The direction here, the slope is the same, even though they have them coming down a little faster. Okay, let's turn our attention to earnings, corporate earnings. The green bars represent the earnings on the S&P 500 over the last 12 months. Okay, and those have been $222 a share. The best analyst estimates going forward are for earnings to be $218 a share. So that is a contraction of just about 2% on corporate earnings. Okay, the next chart also shows the corporate earnings that they've come down almost 13% since last April. So this is just, these are the analyst earning revisions coming down. Okay, and so they have revised downward. Maybe they have further to go. That's the big question right now, is have we started an earnings recession yet? Are earnings going to continue to go down? And we're going to look at a couple of slides here in a moment that show that earnings, earning recession doesn't necessarily coincide with the market's bottom. Okay. So again, what we're looking at here is we're looking at the green line of earnings, the white line's the S&P 500, and you'll see that earnings drive the market. You know, earnings go up, the market follows. Here you can see that earnings have continued to go up. Maybe they need to be adjusted down, but there's been a disconnect. The market's actually dropped when earnings have maintained their upward momentum. Okay, so that again is because of the 10-year, the rise in the 10-year bond. That's the disconnect, because normally you go, well, earnings have been strong, so the market should be strong. Well, why isn't the market strong? It's because of the valuation effect, the downward valuation effect on companies and the market based on the higher interest rates. Okay, so that's how you rectify those two. Now let's look at this corporate earnings and when things bottom. In the top panel, what we're looking at is the S&P 500 in this white line. And you'll notice that this yellow line intersects where the market bottomed, but corporate earnings measured on the bottom panel by the blue line, they didn't bottom until after the stock market did. Same here, market bottomed, earnings followed. And so again, that is evidence that the market's looking forward, not backwards. They're not looking at what earnings were. They're looking at where earnings might go in the future to drive valuations, okay? Now, that's not always the case, okay? And so when we look at this in a tabular form, we can see that at 1961, 87, and 2002, the market bottomed after earnings per shares bottomed, okay? So it can happen. Equities typically bottom 11 to 12 months before earnings per share, okay? So again, that gives us some comfort in that, well, if you think the market's bottomed and you don't think earnings have bottomed, that's kind of a natural pattern that we've seen historically. So what does it all mean? Well, right now the market is at 4105 on this date here, April 6th, that I pulled this chart. And the best expected S&P 500 level 12 months from now is 4611. So that represents a 12.3% increase in the stock market. So how do we get there? If earnings are going to be -2 and dividends are 2%, shouldn't the market do 0? Okay, so how can we get to a 12% return? Well, we'd have to have what's called a PE expansion multiplier effect. And historically, over the last 20 years, that's basically been 0. However, over the more recent history, over the last 5 years, there have been exceedingly high equity risk premium, I'm sorry, not equity risk premium, but PE multiplier expansion effect. And so that's where we could still get to a 12% return, even though negative earnings will wash out dividends. If the PE expansion multiplier effect rises, then we could end up with a 12% return in equities. So what's our outlook? Well, our 12-month view on these different asset classes is shown on this chart. Now, you've probably heard me say in the past, why am I bullish and bearish? Well, I think I could walk into a courtroom and convince a jury why the market's going to go up. And I think I could walk into the same jury with the same data and convince the jury why the market's going to go down. So we're still cautious. We put some cash back to work. We've taken off some shorts, but each portfolio is following its mandate, doing what it's supposed to do. So there's reasons that we could be bullish, and there's reasons that we could be bearish because of the geopolitical events in the banking sector and in the recession. So we're not out of the woods yet. And these outlooks, remember, also are over the next 12 months. If we're going 3 to 5 years, I'm definitely much more bullish on equities than I am if we're talking about the next 3 to 6 months. Okay, so we international equities have been performing well. Emerging markets, we still like emerging markets. We're neutral on the U.S. fixed income market, bonds, except we're very bullish on our synergy-focused bond portfolio. We're bullish on it because it has about a 5+% expected rate of return with a 5% coupon, and it has it's an investment grade better portfolio, and so it's a great risk-adjusted portfolio right now, and it looks like you should be allocating some money towards it, in which a lot of you do, and a lot of you will continue to do. The U.S. real estate market, we're neutral on it. Office is obviously challenged. There's different pockets of real estate that are challenged, and there's pockets that are going to do very well. Real estate is also regional, right? So overall, we're concerned about U.S. real estate. The flip side to that is you always want to buy low and sell high. And so for those of you that want to put real estate into your portfolio and have cash available to do so, you might have some opportunities coming up here in 2023 and beyond. Okay, so again, 2023 may bring some opportunities, right? So going forward, we're expecting lower long-term rates. Risk versus inflation continues to be the battle, but inflation is falling. And with rates coming up, people are starting to get yield, so that's better. You don't want to fight the Fed. A pause may be coming. Again, we looked at that, how the 2-year is lower than the Fed funds rate, and we also saw how that led to the yield curve is inverted, so those are concerning. There's definitely an increased opportunity for active tactical management. There's definitely, you definitely want to be allocated across the portfolios and deploy patience. Okay, so those principles are still working. A fun fact is that the market's 2 years of negative returns in the market's possible, but highly unlikely. Okay, so again, there was a negative year in 2022. To have a negative year in the market in 2023 is unlikely, although it's still possible. Risk management has definitely been popular, but it's starting to swing as the market really swings back and finds its leg into a risk on mode. Then we're going to want to, per the cycle uh, evidence that we looked at earlier, we're going to want to rotate to more equity and out of allocation and out of bonds, but we're not quite there yet. We still think that you should be somewhat hedged, and we're still hedging our bets in the way we manage our portfolios. Corporate earnings may hang in there. We just started earnings season. I was going to show you some charts on that, but it's too early. We're right in the beginning of earnings season, so we'll keep you posted on that. The dollar has been stronger than a lot of people would like. It had been, weaker, but we're just going to have to watch that and see what happens on earnings. But so far, they've been holding in there pretty well. And then, of course, the banking crisis fallout. We're still watching that. And even though maybe the acute episode of Silicon Valley Bank and Credit Suisse have gone by the wayside, there's still a credit tightening cycle that's happening. There's still some banks that have some concerns. So we're watching that closely. Okay, so what should you do? Well, clients should hold enough cash to make them comfortable, whether that's 2 months or 2 years, it doesn't matter. I don't know, there's not a right amount, it's all individual, but hold enough cash that you're not concerned. We also want to be evaluating the time horizon and the other factors of investment policy statements. Remember, each investor has a unique set of goals and circumstances or constraints. So everyone has a risk and return goal. Everybody has an investment time horizon, liquidity needs, tax concerns, legal issues, and unique circumstances. And so anytime that there's a material change in one of those 7 factors that makes up an investment policy statement, we want to have an open conversation about the portfolios and how to adjust them, okay? So if you just want to make sure that everyone's communicating changes and objectives and constraints. And then, of course, we have to be patient, okay? Sometimes when there's a lot of turbulence and a lot of uncertainty, the best thing is to slow your roll and not try to outsmart the market. So we just have to be somewhat patient as well. As a manager, what are we going to do? Well, we're going to continue to manage cautiously. We're continually monitoring and adjusting and communicating the data, okay? So it changes every day. Of course, we don't want to change the portfolios every day, but we will adjust them as appropriate per their mandate and as necessary. So we love doing this work. We thank you for giving us the opportunity to manage your money and to pay attention to the market. And so we will continue to stay on guard, okay? All right, let me just jump into part 2 really quick. This is just showing some fun facts of the market. Right now, growth's back in favor over value, where last year value was in favor over growth. So that's why we saw the NASDAQ do so well this year in the first quarter. We've seen that there's been a rotation back to large companies from small companies. Okay, so again, we saw at the end of the year here, small companies were in favor, and now we're seeing that large companies are in favor. We're also seeing a resurgence in market cap returns. Last year, predominantly was a market equal weight, and this year we're seeing a market cap weight. And so that helps us make portfolio decisions by knowing, should we be in more growth companies? Should we be in smaller companies, bigger companies? Should we look at buying fewer stocks because of the market cap weighted effect? Should we be buying more stocks and more more securities because of the equal weight? So this might not mean a lot to you. I understand that. I apologize, but these are the things that we look at to make the portfolio adjustments. This chart's also very interesting. What we see here is we've ranked the sectors fundamentally. So we looked at forward PE ratios, we looked at growth, price to book, debt to capital, and we ranked them. And what we see is the number 1 sectors, energy, then telecoms, then financials, then materials, then healthcare. And of course, these are defensive sectors that we thought would be doing very well, but this year so far they haven't been. Remember the first cycle chart that we showed you. So again, fundamentally, they still look very attractive. They haven't had the momentum, they haven't been in favor, but fundamentally, they're still saying that's where you should be. So if we do get a recession, then these fundamentals are going to matter more. If we get a sustained or severe recession, these fundamentals will matter more. Okay, and you'll probably see a rotate back out of growth, back into value, and back into these top 4 or 5 sectors. Okay. The next slide I know is always a clock building slide. It's the VIX, it's the volatility index. All we use this for is to say, hey, how much can the market go up or down? And based on the VIX, we expect the market to move 18%. Now we just don't know if it's going to go up or down. Okay, so if the market it can move a 760, we could go down to 3340, or we could go up to 4861. But the range is about 18%. So again, if we're expecting a 12% return, you can move up and down from there for 18%, and that is your kind of the range, the expected range on the market. Okay, so we could definitely see a down 10, 15, 20% still as just as equally probability that we can see returns at that 12% mark based on the analyst consensus. So every month I value all the stocks in the S&P 500, and we value all the asset classes. And so our last work, and this date is incorrect. That's not updated. This is as of April. Okay, but that's an error on the chart. But as of April, the long-term 10-year expected returns on the market, large cap is 7, emerging markets 9, small cap 7, corporate bonds, international equity, short-term bonds, mid-cap bonds, real estate, commodities, U.S. high yield, and tips. So we take these expected returns and the risk characteristics, and we use that to form opinions on how we make portfolios and how we build and conform to portfolios. And so for a diversified asset allocation portfolio, there's a 90% chance or 90% probability that a diversified portfolio will live somewhere between negative, let's just call it 10%, and positive, let's just call it 20%. Okay, so it's technically 9.5 to 21.2, but 10 and 20 is close enough 90% of the time, with the mean return of about 5.95%. So again, on a prior slide where I said we expect rates to be, returns to be lower for longer, this is where that data comes from. It's because an optimized portfolio based on the expected future returns and risks on the market give a diversified portfolio, a 5.5 to 6% total return expectation. So that's where those come from. Okay, well, with that, I'm going to wrap it up. And thank you very much for taking the time to listen. Of course, if you have questions, please give us a call. But we love doing this for you, and we will continue to adjust the portfolios and help us navigate and negotiate the pitfalls, whatever they may be. And again, we have to manage regardless who's in office or who's not in office and what's going on geopolitically. So again, we will recalibrate the portfolios as our feedback loops call for it, and then we'll communicate that to you. So once again, thank you very much. We really appreciate it, and we wish you a wonderful day. Thank you.